noticed any of that. Yeah, I think it's me lagging on the lag. All right, enough with it. Where's that music coming from? All right, good morning. Oh, you don't even have a camera. See, everything is weird today. I guess that's a blessing. Do you need a camera? Well, I guess it's a little better, just so you know who's talking. Camera, video capture, add source. How about this one? Oh, yeah, dude, I look bad. Oh, hang on. It's so funny. One of those mornings. There we go. So anywho, yeah, we'll put me there. How's that? We'll put me in the parking lot. So good morning. My name is Wayne McDonald. I'm a currency trader like you. I've been doing this now. Well, this is trading on farm payrolls. I did 20 years live at FX Street. So this is 20 years and 3 months or something like that. Just this doing this event live with an audience. So that's cool. I've been around longer than that. So I've learned a few things. So today what we're going to do is we'll do some technical analysis. We'll do some fundamental analysis. We'll use quantitative analysis to measure market sentiment. And we can see if we can make some logical, intelligent trading decisions today. See if we can get a scalp or a spot or a swing or a carry trade out of this thing we called NFP. But be careful, because it is summer. Yeah, it is summer. And it may not respond like you're totally used to. So let's start with let's do a poll. Start a poll. Okay. What should we do? Risk on or risk off, or should we do news related? Well, let's just do a basic risk. Well, what are you trading today? Question mark. Very risk on. Risk on. You know, this is what I typically do, right? Risk off and very risk off. Years live. What do you stink? Smell like a plan? Yeah, boy. Now I'm making a fresh pot of coffee. I plan on being here 2 or 3 hours. As long as you guys are active. I'll let you be the boss if that's okay. So let's get an update on market sentiment, just kind of what's going on in the world right now. Good morning, Aiden. Hello. He's been funny lately on when I live stream. That's interesting. Let me see, that's probably just have to kick the server a little bit. We'll have them read that. We want to look at the stock market. It's about the same. VIX, I'm happy at 15. Hey, 15's fantastic. About a week ago, we were closer to 20. 20's bad. 15's not good, but 15's way better than 20. Bitcoin up near 65. Gold, pretty close to 44. So those are nice things. Oil's 76. We were enjoying 75. Hey, the geopolitics on, off. But and dollar back to basically 100. I want to see dollar at 97, 96, 95, 94. That would all be risk on. But unfortunately, yields are on the rise again. Wah, wah, wah. No so good. No so good. Let's get an update on the news, what's going on right this
Euro.
second.
Upside bias hinges on 1.65 break against US dollar. UUB. US July non-farm payrolls to test expectations for a September Fed rate hike. Taiwan trade surplus grows in July.
Gold rises above $4,300 as traders brace for US non-farm payrolls.
US dollar. Strong payrolls may offer only limited support. BBH.
Gold rises as key payrolls data. Mid-East uncertainty loom large. De La Espriella to take office as Colombia president on pledges of security crackdown.
Oil. Prices jump on Hormuz tensions. MUFG.
Indian rupee drops on oil price bounce. US NFP in focus.
Series C 40 up 0.52%. as market awaits U.S. jobs report.
It's cool. Now, the idea of this page, just so you know, is that if you're focused primarily on your charts throughout the day, you can just open this page and run it under your platform. So you're staring at your charts, you're going through your charts, you're doing your technical analysis. Meanwhile, every few minutes, it's not a lot, every few minutes, important news comes out related to trading and investing. And you just hear it. It's a squawk box. So all of a sudden you're staring at your charts, and throughout the day you're updated as things are happening. And you never have to take your eyes off your charts. Isn't that nice? Hey, yeah, so we got US non-farm payrolls, for show. But we also have kitty cat jobs. Huh? Interesting, right? What else going on? Gold on the move, silver on the move. Yeah, baby, yeah. Dow, Ethereum. Once again, we had Ethereum going up 23% in July, but our data also showed, despite that massive move up for Ethereum, it was going to give it all back in August. And so far, it's one of our biggest losers today. I mean, it really has. It really did jump exactly 23%, maybe 24%, and then it came back around, and I think it has given it all back. Just amazing. Anyways.
US dollar index price. Forecast. Likely find direction after US NFP release.
Oh, wow, there's some news. They're like, dollar will do something after non-farm payrolls. Thank you, Hefik Street. That's amazing insight. Hey, look at this. By the way, do you mind if I drink yesterday's coffee? Ugh. So right now, the last couple of days have been quite good, and then we kind of calmed down. And we're flat, but it's kind of interesting how we're flat, but ever so not happy with the situation. So once again, irrational exuberance, like, oh my God, there's going to be peace in the Middle East. Wah, wah, wah. Nope. Okay. But look, nice recovery, nice rebound, huh? Nice rebound, Robin. Rodman. Let's take a look at how we get to these conclusions, because it's important that you have buy-in. If you don't believe the numbers because you don't understand the numbers, and then you're not going to use the numbers, and then what's the point? Okay. So take a gander here. Okay. So we'll take a look at this. We're looking at VIX. Now you have to understand what VIX is. A lot of people say it's a fear gauge. Oh, really? What do they survey people? How do you feel right now? Are you fearful? No. How about you, sir? Are you fearful? Nope. Madam, what's your level of fear right now? No, that's silly. That's kindergarten crayon stuff. We have to know what it is. It's really a measure of whether people are hedging or not. That makes way more sense. So, are institutional investors hedging? Now, when you're an institutional investor, let's say you got $10 billion, you spent 5 years building a portfolio, and you don't think August, September is going to be a great period of time, and you're very excited about October, November, December. What do? Dump your entire $10 billion portfolio because you're like, I don't feel good about this one, Sarge, right? Like, it's not even that. Like, or you've planned for August and to be benign and September to be a dip because of, things like rebalancing and all these things that need to happen at the end of the quarter. And then what? And then you got to deploy your capital. Like, you're not afraid because you understand. Oh, I see all the good mornings there. Hey, good morning. So you're not afraid because you're not in the dark, you're in the light, you're illuminate, you're illuminated, right? Not right? You have the data, you have the knowledge. So in this case, what do you do to your $10 billion portfolio? Well, you hedge. Well, how do you hedge? With options. So stop listening to people that say, oh, VIX is a fear gauge. No. It's a it's a way to read risk management. And so VIX is pretty high. Now, it's much lower than it was before. That's also important data. So we don't like it at 15, but compared to 20, it's amazing. So what is it measuring? It's measuring options. What kind of options? Options used to hedge the portfolio. You don't want to sell, so you hedge. If you think about the psychology of this one data point, it's amazingly powerful. So if the stock market's coming down, but it's being hedged, it's different than just selling like crazy, right? All right. So we have legal and ethical inside information. We can see what institutional investors are doing, and then we value this information a lot. So we weight it. 20% of our analysis is simply the VIX, because we can see what's happening to trillions of dollars of investments into the stock market. And if it's not trillions, a lot. So it's better to have the data. So it's options specifically for hedging and specifically on the S&P 500. Okay. So less hedging is good. So you see over 30 days, there's been a drop of 5.46% in the VIX, and we give that a good score. You see that? It's good. It's down almost 11% over the last week. Wow, hell's bells. That's also very good. You see? It's up a little bit today. Not so good. So that's one data point. What are institutional investors doing right now? And by the way, we do this calculation several times per hour. We probably do this calculation every 3 to 5 minutes. I can't remember. Just this one calculation, updated in near real time. So you can say, "Oh my God, look, they're dropping their hedges. Look at VIX." If we hit 14 today after the news, dude, institutional investors are game on. I would assume the stock market is up. Why? They dumped their hedge and they're going long right now. Well, not right now, but if you were watching that in real time. Okay, one tiny little data point. All right, and so we also look at gold. We look at the put-call ratio. We look at the 10-year yield, the S&P 500. We look at the 5-year break-evens, the 210 spread, the Nasdaq, the DAX, right? Tracking the German stock market, the Dow. We track the US dollar, WTI, 2-year yield, investment-grade bonds, junk bonds, 5-year forwards, the Japanese stock market, Bitcoin. You're like, oh my God, Becky. Oh my God. Oh my God. And so we do that. We weight each one. We look at it over 3 time frames. We make an aggregate score, but we could also break it down into digestible pieces. Today, flat. This week's been good. Okay. So on and so forth. Nice, right? So when we answer the question, what are you trading today? Yeah, risk on seems appropriate. Some people put in very risk off. You're not aligned with the market at all. My guess is you're spending way too much time listening to the news, and in particular, probably a particular political party, or maybe your neck of the woods. Maybe you're in Timbuktu, and and everybody's sad today, and you're picking up the vibe, and you're like, "Oh man, everything's crapola, everything's risk off, man. This is terrible. You couldn't get worse." No, you're misaligned. very risk-off people. You're not looking at you're not measuring the institutional behavior of our financial markets. You're using your feelings or your gut. But you're not managing trillions of dollars. Our aggregate is. So remember, I don't care what you feel. You need to trade with how the market feels. You see? All right, so for those that are risk off and very risk off, wah, 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 thumbs down. I can't quantify that at all. Remember, it's not my opinion. It's just I've done, hundreds of calculations, and no, you're not aligned with the market. And then very risk on, okay, look, you feel pretty bold today, and I'm sure you're going to be able to justify it. But once again, you're not aligned with the market. You're like, oh my God, Wayne, but, we're pulling a 3. Yeah, well, we were like a month ago, we were negative 14. So you can't be very risk on if the market is like kind of bullish. Also, the reason, another reason that we're not incredibly bullish is we're not seasonally supposed to be bullish. So you're a little bit too aggressive. You may personally be very, very bullish, but the market is not, and you might be early or you might be wrong. And what could change these things? Well, it could be non-farm payrolls, sure. And we're going to have a nice conversation about that. Don't you worry. Make sure I cover the dual mandate. Jobs and inflation, right? Price stability, full employment. Because that's what we need to analyze today, right? Is this going to move the market? Well, do you think the headline is going to move the market? No. So what will move the market? Whether the news comes out is likely to impact Fed policy. That's the difference between most, benign or exciting non-farm payrolls. The other thing, of course, is it's shocking. The number comes out ridiculously good or ridiculously bad. But why the heck would that happen? You think this is magic, hocus pocus stuff? No, it's just not probable. Now, it could happen, and we could read the market. But are you planning on something that is not probable? That doesn't make a lot of sense, right? You're looking for conservative, repeatable trades. And by the way, for those that love charts, don't worry, don't freak out. You're like, where's my charts, Wayne? Just show me. Whoa, we'll get there, bro. We'll get there. Okay, we'll get there. All right. We'll do the spike radar later. I just really want to point out that Jiminy Cricket, that we have CAD jobs, not just non-farm payrolls. Okay. What is my view of what? Excuse me. I'm going to have to go get cough medicine. I am sorry, guys. It's just tickling like crazy all of a sudden. Big spike in commodities. Often that's related with dollar weakness. Okay. Let's go into the indices. Definitely dips or reversals. Okay. But I still, what do you mean about the news? You're talking, what's my guess on the number? Well, first of all, I have no idea on the government's even capability of calculating these numbers. Like, it'd be a guess. It doesn't, why would I guess? Gee whiz, I'm going to have to get a, okay. Okay. ICE, dude, rewind about 5 minutes. I just covered it in like in great detail. I just covered that. Just rewind a little bit, bro. Okay. Yeah. So anyways, these may be dips. We're bullish, but so they're down right now. Not by much. You can see Dow is down, but we expect it to be up. Take a look at currencies. Everything up in the top right quadrant is expected. So all the yen pairs are up, all the Swissy pairs are up, but we talked about that, I don't know, 2 or 3 days ago. All these pairs are supposed to be down, and so we got those right. So the out of position, see, it's contrarian. So these, okay, we just don't expect CAD to be strong right now. We're not happy with that. And we're also a little disappointed with Australian dollar weakness. We didn't expect that. So this is where we're wrong, or at least it's contrarian. Maybe you sell the rips or buy the dips. That's really what it's for. And all of these things are already happening the way that we planned. Now, planned. Yeah, well, that's fundamental and technical. This is a combination of technical analysis and fundamentals. Okay, commodities are hot to go. Energy's down a little bit, which is what we want. Crypto not having a good day, but that fits into the seasonality, so on and so forth. Okay. So, in the Zoker, love from India. Namaste. All right. How does this all connect? So we looked at the scatter plot, the contrarian radar. What should be up versus what is up. What should be down versus what is down, right? Long-term macroeconomics versus short-term price action. That's what the contrarian is, because you're looking to buy dips. Is it really that helpful for you to find out like euro dollar's already up 1.5% and it's the biggest winner, let's say? I'm just making that up. Well, it's already happened. Where were you? Okay. So what you're trying to do is find opportunities that may arise in the near future. And that's why the scatter plot was a contrarian. We want to see things that should be up but are actually down. That could be a dip, and then you go to your charts. But how do we get the should be? How do you define that? So like, why is Aussie Swiss franc the best currency pair to be trading right now, even if it's not performing well today? Remember I showed you? I'm sorry. I'm trying to talk as much as I can without coughing, and at some point I'll have to go get some cough medicine. But how do we get to that number? How do we get to 3.74? Okay, so what we do is we go to the table form. Same data, 3.74. We expand. And look, we do all kinds of stuff to get that number. For you, it's just like Aussie Swiss franc should go up. Why? We're looking at hedge funds and seasonality, the technical trend, momentum in the technical trend. We create a synthetic indice for Aussie. So we look at Aussie versus all currencies. Then we look at Swiss franc versus all currencies. Create the basket index for Aussie and Swiss franc separately, and then compare those two baskets together to create a score. Based on that, it should go up. We look at GDP, inflation, jobs, and interest rates in the two economies, do comparative analysis, as you can see here. Okay, August is usually a dip for Aussie Swiss franc going into September and October. So what this should do is, if you can find an opportunity to get long Aussie Swiss franc, you might be long till the end of the year. Stop shooting for 25 pips if you can be in it for 2,500 pips. In fact, instead of one trade a day and you make 25 pips and then you leave, and then the next day, I am so sorry. You try again. Sorry, I've been sick for a couple of weeks. I went to Vegas. I met 4,000 traders, and then I went to a board retreat. So I've been traveling, and I've been on. So, anyways, yeah, I need pills though. But let me finish this, and then I'll go do that. So one thing you can do with this knowledge, first of all, you have the confidence. And the second thing is, instead of trying to make one trade a day, 25 pips, a second trade, and maybe the next day it gives or it doesn't give, your timing is right, it's not right. Instead, you should look at it like, hey, every day I should take a trade and move my stop to break even. And the next day, take a second trade and move my stop to break even. And then third day and fourth day, knowing that this right here shows there's a dip and a turnaround in August. This doesn't mean August down. It just means there's usually a trough in August, and this might be it right here. That could be the bottom of August. And then it goes up September, and then it goes October, and then we also have data that we can look it up if you want, but further out than 90 days, does it usually go up? The answer is yes, yes, yes. So what if 90 days from now, you had 50 trades, every trade at break even, and it's been running for 3 months? I bet you'll do a lot better than your pissy little 25 pip per day trade. Remember, to go from rich to wealthy, day trading and scalping can make you rich. Rich is just money. But the problem is, you make money for 3 days in a row, and then you give 30 or 40% of it back on the last day, and whatever. And it's hard work. It's like going down to the mine and chipping away at the hard stone. Sometimes you find a nugget, sometimes you don't, and you don't know. Every day you don't know. Wealth is where you make money while you sleep. It's engineered. And the analogy here is like you own the gold mine. You're not down there chipping away. You own it. So you own, let's say, Aussie Swiss franc. You're like, I am long and strong. Why? Because I have all this data. So you add a trade and let it run, add a trade, let it run. So imagine just now you have 10 trades. Every trade you took individually. It took you a couple of weeks, maybe 3 weeks, maybe a full month to get the 10 trades. But you got to stop at break even, right? And let's say for whatever reason, you just can't trade anymore. Well, you have entered what will probably, based on what is usual, there usually is a long trend. And you have those 10 trades in, and let's say it took you all of August, and then you can't work September, October, November. You can't trade for whatever reason, but you're still in those trades, and you know those trades will probably run. That means as long as that trend is in play, and we have the numbers to say it usually is in play, then you're going to make money while you sleep. You'll just wake up, 10 trades, you're like, oh, I made 200 pips today. Your old business model, you were trying for 25, but 10 trades, and you're up 20 pips per trade for the day. That's not a good day. You're disappointed with 200 pips. So now that's wealth. All right, let me go get, see, I'm losing my voice. Let me go get some pills and I'll be right back for the headline number. Don't worry, we got enough time. So I'll be back. It'll take me 4 minutes, or probably even less than that, huh?
US dollar index price. Forecast. Likely find direction after US NFP release.
Euro. Upside bias hinges on 1.65 break against US dollar. UUB. US July non-farm payrolls to test expectations for a September Fed rate hike. Taiwan trade surplus grows in July.
Gold rises above $4,300 as traders brace for US non-farm payrolls.
US dollar. Strong payrolls may offer only limited support. BBH.
Gold rises as key payrolls data. Mid-East uncertainty loom large. De La Espriella to take office as Colombia president on pledges of security crackdown.
Oil. Prices jump on Hormuz tensions. MUFG.
Indian rupee drops on oil price bounce. US NFP in focus.
Silver price rallies to 6-week high ahead U.S. jobs data. Euro, Fed repricing supports moderate gains against U.S. dollar. Commerzbank.
US dollar. Fed tightening risks keep outlook bullish. OCBC. WTI oil pulls back below 76.0 US, with markets pondering talks to reopen Hormuz. Mexican peso. Restrictive Banxico stance supports MXN carry. Rabobank. FTSE 100 up 0.72% as miners surge.
Almost ready. Yeah, boy. All right. 4 minutes so lonely. All right. Dum dee dum dee dum dum dum. All right. Let's move on. I'll just burn through some things quickly. Oh. What did he do? There we go. I finally got the pills down. Bump, 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 bump. So one of the key things that that's going through my mind, like when it comes to NFP, is the trend in the data. Does any of it suggest the Fed actually needs to do something? And so we talked about these things like the dual mandate of employment, full employment, right? And having stable prices. We want some inflation, but not too much inflation. And we don't want volatile inflation. We want flat inflation. So I'm just burning through some numbers here. And what you'll see is there's nothing really dramatic going on that would really dictate a true need to change policy at the Fed. Now, I know everybody's talking about it. But let's break this down because we want to be logical, and then we can also do some trades, right? Or trade setups. The logic here. Employment is steady. Okay. And to me, the most important part is this number. It's not necessarily them maintaining full employment, because if you're at full employment all the time, that'll eventually lead to inflation. And then they got to do something about that. What do? Raise interest rates. But if unemployment is spiking, it may lead to the Fed cutting interest rates. Does this look like a spike or a crash to you? Not to me. Okay, look. Okay, so this, and we project it to maintain this rate. So, dumb it down. Why is this important? This says the Fed doesn't need to change interest rates. Now, the market is pricing in a hike in September. But if they do, it wouldn't be related to unemployment. So we'd have to have something pretty crazy happen today for this to impact. Remember, dual mandate. So if we're trying to figure out if the Fed's going to raise interest rates in September, this is one half of the equation. And the answer is no change. Now we can measure how other people are placing their bets, but it doesn't mean they're right. It just means we can read their dumb ideas and know that it's happening. We don't want to fight against the dumb idea, but once they realize they're wrong, the market will snap back and trade the way that you expect. So you don't want to front run it. You just want to know what you think is going to happen, and you also want to know what your adversaries are doing before you engage into any battle. Okay? So anyways, when it comes to unemployment, bro, no need to change monetary policy at the Fed. So then it comes down to inflation, doesn't it? And that's a whole different study on a whole different day. Okay? And that's not printing quite right, obviously. Jiminy Cricket, I am so sorry. Remember, I'm sick because I've been hanging out with traders. It's not my fault. It's good that I'm sick. It means I'm trying. All right. So, yes, we can do some position trading, but this is a short-term vol trade, isn't it? So we'll look at these other charts, for show. But really, this is a vol trade, a high, right? A high volatility event-driven strategy. So one of the things we could do here is just see what is happening in real time, and you can adjust as the market adjusts, because you might see dollar go from strong to weak, or dollar go from strong to stronger. Okay? And we can see it in real time. Now, the nice thing about this is you're like, well, what do you mean CAD? Well, to get this number, we're looking at 1, 2, 3, 4, 5, 6, 7 different currency pairs. See? Every single one of these, we're measuring the relative change of 7 different currency pairs to create a basket, a synthetic index of the value of each individual pairs. And we're doing this every couple of seconds. So what if yen just went, after non-farm payrolls, what if yen went up, 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 green, 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 whoa, 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 you'd see it. But see, as a retail trader, very often we're just staring at one chart, aren't we? You whittle it down, you're looking at euro dollar, and you miss the fact that the yen is spiking out of control and all the yen pairs are collapsing. And you're like, oh man, my euro dollar's not doing much. Yeah, well, euro's a little bit strong and the US dollar's stronger. So it would be falling, but it wouldn't be that dramatic relative to all the things you're missing. You're doing the right thing. You have the right skills. You're at the charts at the right time, but you're looking at the wrong asset. And how could you possibly know which one asset to be looking at when there's 27 different currency pairs with multiple time frames? How could you possibly? Okay, well, we do it this way. Okay, amazing, right? So, for example, dude, silver. You need to be on silver. Did you know that? Okay. Yeah. Did you know risk looks off right now? Yeah, it's swinging back around as we go into NFP. Well, what if suddenly after non-farm payrolls, this goes green, 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 green? Well, then all of this is likely to change. Although I would guess these two would stay weak. I think Aussie and Kiwi would bump up the ladder here. And risk on would probably pull CAD down, because risk on is probably going to be related to energy. And risk on would probably mean a deal with the Strait of Hormuz, and oil prices would come down hard and CAD would give back. Aussie Kiwi would go up, yen and Swissy would stay weak, US dollar would collapse, metals would continue to rise, crypto would go up from mediocrity to up, like stock markets would go from red to green. Boom, boom, boom. All of this is all related. Newtonian physics. Okay. It's a cool little tool, isn't it? So imagine that you can watch, 100 charts. To make your decision of what you should be looking at right this second. Isn't that cool? Or you can organize it like this. Okay. Or you can organize it like this. What do you think? Nice and easy, right? Sell Kiwi. So, right? Looks like we're buying CAD today. Buy CAD. Buy CAD. Okay, silver's up. Look at like, how could you miss this? You couldn't miss. And notice that it's giving you conviction. So it's like CAD yen, but we don't love it. CAD Swissy, but we don't love it. It's cool, right? Look at the conviction score of silver. Up, and we love it. Gold, up, and we love it. A lot of this comes from like our COT as well, right? Again, ethical, legal, inside information. This is exactly what institutional investors are doing with their money right now. They're selling these assets. So CAD is strong right now. It was strong yesterday. I don't care. I'm a bear on CAD. Isn't that cool? So this is long-term positioning. This is cash flow. Okay? Institutional investors have been selling CAD for a long time, and they sold a little bit more last week. They've been long Mexican peso for a long time. They got a lot of peso in the vault, and they bought more. Isn't that cool? So you want to look for divergences, but you also want to do that around seasonality. You want to predict when the divergence will end. So like euro dollar, there's going to be a dip in September, and somewhere in September it's going to roll over, and euro dollar is going to go up. Well, that would be the historic norm. Okay, and we have it all priced here. Look at this. It's all been done, guys. So then you what you do is, if that's what your prediction is, you can confirm it with your COT. When do institutional investors, okay, pop it into currencies, start buying euro and selling dollar? Well, they definitely didn't do that last week. But now if you were somewhere at the end of September and all of a sudden you saw a huge spike in buying of euro and a collapse in the US dollar by institutional investors. Remember, this is institutional investor factual data. This is not guessing. This is not AI. I'm pulling this from the Commodity Futures Trading Commission. This is directly out of the government database. It is real. It is happening. It is the source of truth. And you expected it, so it gives you confidence to get in on it. You see what I'm saying? You know what I'm talking about? Let me reboot my platform. So what are we expecting? 80K? Hang on. Come on, MT4. Let me grab you. So here's our trade plan from 2 days ago. Oh, it's so good. Yeah. Cool. Oh, it's so good. So, what's the best thing to look at right now? Do you know? CAD Swissy. Is it going to change? Yeah, I don't know. Okay. But you could play it that way. It's just that easy. Or you're like, you prefer this version. Or you want to look at multiple things because you want to see changes. Yeah, there you go. Problem solved. What if you prefer like looking at charts, you can, what was it? We still got a few minutes. You can do day trading, turn on all the pairs. And it'll show you of all the pairs. Okay? Yeah. Okay. Now, you can do that for crypto and all that kind of stuff too. But what I prefer to do is actually, I like to step back a little bit. And I like to day trade into swing trades, not just short-term vol. So for me, I would look at it this way. I've just looked at the swing trading, okay, defined by the 4-hour chart with monthly pivot points. And when you look at it this way, Aussie Swissy is your best bullish trade. Euro Swissy is your next best. CAD Swissy is your third best. And now you're also doing technicals. This is showing fundamentals and technicals here. Okay. But you know how to trade, right? You get it. You got this. This is good. So, yep, this is maybe buy, maybe buy, maybe buy. So we're looking for dips. If then you want to go all the way to the bottom and it shows you the best selling. Swissy yen, Kiwi yen, pound yen, USD yen, Euro yen, CAD yen. Whoa, Aussie yen. You notice this? You're like, wait, all the yens are coming down? Uh-huh. Yeah. Apparently, we got 83 seconds to go. So just for fun, I'm going to pull up something obscure that you may not be watching. I was going to go for the Aussie Swiss franc. Okay. And oh my God, we already hit our target. So our new target's probably going to be here. Sorry, we hit our target too fast. My bad. So what do you think? 90? Some people are saying 80. Some people are saying 120. You know what? I just showed you it doesn't even matter. The Fed doesn't even care. We're stable, guys. Who cares? Up a little bit, down a little bit. The media is going to freak out. You're going to be sold that it's important. But you should know better. Okay. Well, we pull that. Oh, a negative number. Okay, that's going to be bad. That is unexpected. Ooh la la, that's probably going to be risk off. Okay. Oh, and the markets are moving. So we go here and watch this dollar for strength is my guess. But watch the stock markets maybe fall. Risk should get worse from 1.2. Metals will likely come down with news like that, would be the assumption. It's definitely a miss, eh, Denise? Definitely a miss. What should that do to CAD? That can't be. Oh, we forgot to check CAD numbers. Let's do that quickly. CAD unemployment, 6.5. Oh, it didn't come out yet. Oh, stats CAD, is that slow today? Interesting. All right, let's see if we can get it here. Silver price rallies to 6-week high ahead U.S. jobs data. Euro, Fed repricing supports moderate gains against U.S. dollar. Commerzbank.
US dollar. Fed tightening risks keep outlook bullish. OCBC. WTI oil pulls back below 76.0 drafts, with markets pondering talks to reopen Hormuz. Mexican peso. Restrictive Banxico stance supports MXN carry. Rabobank. US dollar index price. Forecast. Likely find direction after US NFP release.
Euro, upside bias hinges on 1.65 break against US dollar. UUB.
FTSE 100 up 0.72% as miners surge.
US July non-farm payrolls to test expectations for a September Fed rate hike. Taiwan trade surplus grows in July.
XRP price forecast. XRP nears critical 1.00 support.
India inflation steady, trade deficit persists. DBS.
Japanese yen. Intervention skepticism meets BOJ repricing. BBH.
Euro pound price forecast. Mixed momentum signals point to more consolidation.
China exports beat expectations, despite geopolitical tensions.
UBS sees gold rising to $5,000 O's by first half of 2027. Breaking, U.S. non-farm payrolls declined by 23K in July versus plus 80K expected. Yeah, a lot of news going on. Yeah, for sure. So, look, I'm just looking at this. So we did this 2 days ago. And this is the second leg of the trip. This is actually, so we planned this out, I guess maybe it was yesterday morning, right? Yesterday morning, Thursday morning. And our plan was up, down, up. But this is all the way into next week. And we are currently targeting the 1618, but this is already adjusting, so pretty close to 57.5. Yeah, so we have the up. So now, so that's the swing trade. You see the strategy? Higher high, higher low, higher high, higher low, higher high, higher low. Eventually we get up to here for the next leg. So now then you look at a smaller time frame, and if we can hold this, the role reversal, okay, then we can kind of get rid of this part because it's already played out. That was the predicted bottom. Cool. And now we're like, hey, if this role reversal can hold, and I'm not convinced it will yet based on the news, but that higher high could then lead to a new higher low, higher high, and then we're off. And now we're into, we'll be long Monday, long Tuesday, probably take profit on Wednesday. Hey, David, I was texting you at 6 o'clock in the morning, bro. What's up? Yeah, there we go. How come I don't know before everybody else knows? Treasuries rise as 2-year and 10-year yields post biggest drop since mid-June. Come on, brother. Yeah. Yeah. Oh, and thanks for the job offer too, bro. Yeah, dude, seriously, what the Yeah, anyways. Yeah, faux show. All right, so bada bing, bada boom, huh? Bada bing, bada boom. So we're basically seeing if we can catch that. But look, this news is an unexpected. It wasn't on trend. Now maybe it's just a goof because it's July. Maybe it's a goof because of bad numbers, which is, trust me. Maybe it's a goof because of FIFA's little soccer tournament, right? Whatever, it's off trend. Also, remember headline non-farm payrolls is a heavily revised report. And this number is almost certainly wrong. It could be way worse, or it could be not negative at all. And that's something why...
Breaking, U.S. non-farm payrolls fall by 23K in July versus plus 80K expected.
This is why Warsh has a problem with many of the old techniques of measuring things like inflation. And it may not be a good process. CPI, PCE, and other measures are kind of outdated. You know, they're like, oh my God, did you see the price of an iPod? You know, that kind of stuff. Now they use PCE because it's better than CPI to adjust to these changes in technology, but it's not how much is AI influencing it, right? That kind of stuff. So, So Warsh wants to come in and say, look, if the Bureau of Labor Statistics has such, we'll call it deviations. If you analyze the standard deviation between headline actual and the revisions, you might say, my gosh, there's a massive standard deviation in the data reporting, month over month. So with that being said, then there's maybe a problem with reporting. Maybe you don't report the headline and then revise it because maybe the headline is off, because in this case, because it's always reported first Fridays, sometimes that the Bureau of Labor Statistics has only had 2 or 3 days, sometimes 1 day to gather the data. In this case, should have enough, but Canada's unemployment rate drops to 6.4% in July. So what do they call, like 27 million people? So even the way that the data is gathered and the data set is created, if you're randomly calling people, then there's volatility in the data collection versus contacting the same people every month. So anyways, the technique and the timing, if it's not very good, then you can just get random numbers reporting the first Friday of the month. So they could just say, well, we will never report the first Friday for the current month. We should just report the revised number, make that the headline number, and say, no, we need a full month to calculate, so we can give you an inaccurate number. Okay, but then the market's going to say, well, we can't wait all the 4, 5, 6, 7 weeks to get an accurate number because we need to invest. Okay, great. So then Warsh would respond to that, well, then we need a completely different technique. And honestly, calling a bunch of people, now there's an employment, right? The employment situation report has the household survey and the establishment survey. Household survey, it's not even a good survey. So let's just say they knock on doors and they're like, hey, do you have a job? Okay. And it's a yes or no question. They don't even, right? They really should say, well, is it a good job? Are you going to keep it? Are you going to be with them? Do they treat you well? Do you have 5 other jobs because you don't make enough money? Do you have a PhD, but you're a barista? These types of things. And knocking on doors blindly, like, do they answer the door this month versus last month? So you're kind of randomly going household to household, hoping somebody responds. And even then, the questionnaire isn't very good. For example, yes or no question. Does your mother know you're gay? So what questions and how you ask your questions are important. And then the establishment survey, you're just looking at payroll stubs. Way better. So what if the Bureau of Labor Statistics was challenged by the Fed and by by Congress to say, okay, the old way just doesn't make sense anymore. That type of survey for the household survey is just wiggity, wiggity, wiggity whack. So why don't we employ some AI? Why don't we employ some massive data sets with billions and trillions of data points and have AI spit out, hey, the economy is about the same as it was last month. Versus just this random volatile number every month that gets revised, and even then is still probably not a decent. Okay. All right, now let's step back. That's enough of that. Let's step back a little bit and say, what does it mean about the Fed? Well, if unemployment was spiking, I want to go here. If unemployment was spiking, oh, look at the dollar collapse. Oh, yeah, good. This is what I want to talk about. If unemployment is spiking, now it's not really spiking, don't freak out, but you know what just has happened? If the job market is not crazy hot, then there's no need for wage inflation to spike. If there's no wage inflation, that is one thing that inside of the the demand side of the economic equation would show, bottom line, no need to raise interest rates. And so that should take out or drop down bets that September will be a hike by the Fed. Okay. So we have two parts of the economy, according to the Fed. Yes, employment, yes, inflation, but there's also supply and demand. The Fed can only impact demand. When the economy is slow, they make money cheap. When the economy is red hot, they make it more expensive. The Fed cannot do anything, nothing, to bring down oil prices. Be humble, that gets seasonally adjusted. Yeah. But also be humble. I don't know anyone that quits their job to go on vacation. There's also that, huh? Hey, we're going to the lake this weekend. I quit. Take this job and shove it. Okay. Yeah. Okay. So anyways, the Fed cannot do anything about the Strait of Hormuz. They can jack up interest rates to 10%. Yeah, it would crush the economy and spike unemployment. But wait. If it doesn't solve inflation, but it hurts unemployment, then they're hurting themselves because that's against their mandate. They don't want a spike in unemployment. So if they jacked up interest rates in September, the risk for them is unemployment goes up because they slow the economy, but that's not why we have high inflation. The economy is not red hot. There's an exogenous supply shock on the, right? It's a supply side dilemma, not even dilemma, issue. Oil is unusually high because of war. The Fed can't fix that. Raising interest rates won't fix that. And I'm pretty sure they know. I pray to God they know. Okay. So the market just might say, oh, well, now there's even less necessity. Okay, there's less need for them to raise interest rates in September. So let's take a look. Still 62. Let me see if I can get a fresh number here. Okay. Hang on. Let's see if I can update this based on what's happened over the last few minutes. Because what we're doing is we're reading the yield curve. Okay. I guess I have to show you a yield curve, right? Well, it's basically this. Okay, we're reading the yield curve. And the differences between each of these and the flows and the change over time. And we're thinking about the logic. For example, money has been flowing out of the 30-year Treasury because they have the most sensitivity to interest rate changes. Okay? So if you were in the 30-year government Treasury market, and you thought the Fed was going to raise interest rates, the price of the 30-year Treasury would fall. Because if you thought, well, if you just wait until September, you can get a higher rate. So you wait. So the market falls because they're still trading, but investors say to the buyers say to the seller, well, hey, I think the Fed's going to raise interest rates in just a few weeks. So I can buy your seasoned 30-year note, or in this bond, I can buy your seasoned 30-year bond, but we're going to have to adjust the price so it comes out to the equivalent of me waiting a month to get the higher rate. So the value falls. And in fact, the market has been falling. That's what it's showing you. So while this has been happening over the last 30 days, the Treasury market has priced in a rate hike. Doesn't mean they're right. It just means that's what needed to happen in the capital markets. They're pricing things like risk. Well, there's a risk that the Fed raises interest rates. And this one is most sensitive. Okay? But because it still pays a coupon. Now, if you're studying for the Series 65, you'll also think, well, long and low. So what about a zero coupon 10-year? Well, it would have more risk, more sensitivity, more duration risk than a 30-year with a coupon. But we don't need to get into that. That's a little technical. Okay. My volume's low? Is that right? Is it using the right mic? Let me see if I can fix that. It shows that it's coming out loud. Is that right? I mean, I'm my little indicators in the yellow almost red. Oh. What do I do about that, huh? All right. How about now? Is that any better? Little, now is it stereo? In sooth, I know not why I am so sad. No? Same. All right. Well, then let me now go to settings and input. Down, turn monitor off. Yeah, I heard that. Only coming out of the left, but I haven't set it to do that. I'm just trying to see if there's. Let's play around with it. Did that change anything? Yeah. You're fine on the tube. So I set it to some default. About the same. Okay, I don't like it set on default. Microphone there. No, it makes sense, I guess. Down mix to mono. That doesn't sound good, does it? Global settings. Audio monitoring, no. Sample rate, channels. It's set to stereo. Restart is required. It's set to stereo. Audio device 1, desktop on, disabled, audio. I don't know. It looks like it's supposed to work, y'all. Well, that's because it's coming off my desktop. So input should work. It should be working fine, but what can I do? What can I do? It is what it is. I wonder if it's over here on my. Hang on. I don't know. One last chime. Has that changed anything? Probably not. So we'll just leave it at that. We don't want to mess around too much. But anyways, we were looking at the yield curve to see, all right, to see what institutional investors are doing. Legal and ethical inside information. Okay. So we go back to our rates radar. Let's see, I think I might have to update something here for us because I just asked Aiden to update. So I think it's not going to update until we get the market open at 9:30. So here's the thing. Right now, there was, based on not my opinion, I definitely don't have this opinion, but right now, there's a 63% chance of a hike. You can see it right here. It's actually 62.6 at the next meeting. And we have forward guidance. Okay. But it's just reading the yield curve. What do institutional investors think about interest rates? What has been in here, this implied path, okay, by the end of next year, 4 1/4. We're at 3.75. Well, excuse me. So we're looking at the midpoint. So we're currently 3.5 to 3.75. And this is going to be from, 4 and between 4 and 4 1/4. So that's how it gets 2 hikes over the next 18 months, right? So what we care about is not that that's the prediction. This is just what's being, this is us reading the market. Now we have to do a lot of gobbledygook math for this, by the way. So we're trying to figure out the decision-making process. This isn't just something I pull out of a government database and it says, oh, this is what the market is, how the market's behaving. No. So we do all the gobbledygook math, and the way that the market is behaving over 18 months is 2 hikes. 63% chance that September there is a hike. Now, today we got negative non-farm payrolls. Once again establishing that the how do you say, the jobs market, the employment situation is not forcing the Fed to raise interest rates. In fact, that might actually be a bad sign. It could argue for a cut, not a rate hike. And then there's some level of assumption that the people on the Federal Open Market Committee actually understand the difference between an exogenous supply shock and egregious levels of demand from an overheated economy. Okay, inflation isn't high because demand is out of control. Prices are high because there's a supply shortage. So putting all of this together, here's how you make the money. Okay? You want to watch a change today once the market opens. Does this fall? Does it fall significantly? Okay, And that's the news to use. Okay? And so if it were me, I would say the world is going to wake up and realize over the next few weeks, few months, well, between now and September, that the Fed doesn't need to raise interest rates. And I've been saying this for months and months and months. Institutional investors, not all of them, some of them disagreed with me, and that's fair. There's no crime in being wrong. It's not illegal to be a dum-dum, but they need to change their bets. And when they change their bets, now it's game on for the wane, you see? And then I can confirm or deny the trade that I think would happen in that case. And I could say dollar weakness. So now I go to technicals, I go to position trading, which is 30 days worth of data, and I'm looking for dollar weakness. Oh! That's good for the wane. I want gold up, I want Bitcoin up, I want the stock market up. Crypto down. Could be an opportunity in the future for me. U.S. equities over the last month, mediocrity. Hey, I want to buy a dip in the third week of September and ride this out to the till 12/12. Cool. Well, it's yeah, as kind of expected. Metals I want up. Oh, look at that. I own a lot of gold, and it's up 7.7% this month. We're in the last 30 days. Whoop, whoop. Now, to add icing to the chocolate cake, I also earn 12% a year in revenue, in dividends. Love those options. Who likes options? Whoop, whoop, whoop. Yeah. Yeah, how do you do that? Well, you buy a bunch of gold, and then you write call options against them. Yep. Loving life, living large. Yeah. Interesting. So we know the best thing right now, okay, is still kitty cat, which is a bit surprising to me. Oh, look, we could. I don't. We could. David Pegler's a fantastic options trader. I also know somebody else that trades options every week. Yeah. So, but I definitely utilize it for my charitable endowments. Definitely. Because what do charitable endowments need? Low volume, steady income. Yeah. In the United States, the trick, if you are if you're a taxable persons, okay, you're a human being, not a charity, you're a human, you have two choices: a retirement type account or a taxable account. And you're going to use, I'm sure, options as a way of doing it because you still want low vol and steady income, especially when you're too old to work, right? In a tax efficient account, like maybe your retirement account, the government doesn't give a damn how you made your money because you already did pre-tax. Or no, it's pre-tax. So you're going to pay taxes when you're forced to withdraw when you're too old to work. So because there's a million different ways to make money, the government simplifies it and says, we don't give a damn how you made the money. You're paying us the highest income rate that there is. You're going to pay us like you have a job and this is a salary. So you're going to pay about 40% taxes. So you don't need to be tax efficient. The government doesn't care. Hey, you had a tax efficient strategy? Who cares? F you. Give me my 40%. Okay? And when you're 80 years old, that's a lot of money, right? Now, the interesting thing is if you know how to do the strategies, it's very interesting if you look into how the taxing works. You can take a taxable account now. So it's money you've already paid taxes on, right? So you made money in your job, you paid taxes, and then you have a little left over in the kitty. So you're like, I'm going to put it in a trading account. Cool. Standard trading account. You can do virtually the same strategy and get very, very, very low or almost zero on the taxes. And then when all of that runs out, which could last, let's say, a decade or more even, let's say you get to the point where now you're going to pay the highest possible taxes. Now the highest possible taxes are 20%, not 40%. And yet one of them is a tax deferred account and the other one is a taxable account, and I can get you better tax treatment out of the taxable account than the tax deferred account. And it's cray-cray. But you know what? My accountant years ago, 20, 30 years ago, said this. I said, Wayne, there's two types of taxation systems in the United States. One is for poor people and the other is for business. This is why you have to get trader tax status. This is why you need to trade and incorporate your trading business. You get the tax write-offs and you do this and you do that. But you can also save a lot and create retirement accounts, and you can trade your own retirement accounts, and then you make too much money and have disposable income. So now you can put it in your taxable account, but then trade it and get even better, blah, 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 blah. But it's awesome. Or you get taxed like ordinary income because you're not incorporated, you don't have trader tax status, you're doing the best you can, but you're not set up properly. It's an amazing country, right? So in America, you own. So you shouldn't be a Forex trader. You should own a Forex trading business. So anyways, options. I'm not going to teach options directly, but one of the things I'm going to do, I have a group called the Council of Investment Advisors, and we've turned, 50 grand into 125 grand or something like that. Okay, cool. I haven't opened the doors in a long time to let new people in. And I'd like to kind of update the training course because that occurred 2 years ago. And so I think I'm going to add to that training, which isn't specifically trading options, it's constructing and managing portfolios quantitatively. And include a huge section now on taxes. Turns out, if you're smart about it, you might actually do better in your taxable account than your tax deferred account. You might actually make more money and pay less taxes And you're like, but that doesn't make sense. And you're like, I know. That's why you got to be smart. Oh, yeah, our pound dollar? Yeah, for sure. Well, you can see it. Look, pound dollar, right? I don't know. I guess I want to do this. Boop, boop, boo, doo, 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 doo. Pound is kind of growing there. Pound Swissy's probably a little better than pound dollar right now, but they're about the same. And I think we had that too. If we go to the yeah, ooh. You could. This is the zone, which is kind of interesting. It's a big fat giant maybe. Too early though, I think. What was the other one? Yeah, the Aussie we were thinking about, right? The Kiwi I'm not thrilled on. So now let's maybe look at some of the dollar. Okay. And look at this one. Oh, dude, it's so easy when everybody's trying to please my baby. Dude, we did this like a day and a half ago. Dude, shut the back door. Look at that. It's not even fair. It's not even fair. Dude, a day and a half. Not 5 seconds before, not 5 seconds after. No, a day, 18 hours early. We do our analysis. Gorgeous. Yeah, be humble. I've put a lot of time into that because I am also starting an asset management firm, like other people I know that are very, very close to me, like brothers in arms. And I ran into this issue of what works fantastic for charitable endowments may not work fantastic for people retiring. So I looked into the tax situation, and it turns out that you get this good deal from the government where you can pre-tax put money aside for your retirement. And then I find out, well, you pay taxes, the same amount of taxes, no matter what you put into that account. No matter what, you're paying ordinary income taxes. So you're paying the 40% like you had a job. Doesn't matter what you do. So if you have that account, and I do, you can put some money into that pre-tax, and it lowers your income taxes this year. But they get you down the road. But it's okay because you compounded by deferring your taxes, and you made up for it. So, okay, it probably all works out. But it's a good vehicle. And for me, because I make more than $250,000 a year, the government allows me as a small business owner to be very generous, set up a pension fund for my company, which is me, and I can put money in there personally, but also match it with my company. And my company, me, is very, very, very generous. So I can move $72,000 a year into a trading account, which I trade, and I lower my income tax this year. But you know, at 70, when I'm 72, I think I'm forced to take money out of that. I think I'm forced. I'm pretty sure I'm forced to take money out of that account, and when they do, I have to pay 40% income tax. Okay, but I compounded you know, the law of 72, you know, so you compound X a number of times, dude, whatever. I'm good. So that's cool in of itself now. That's another great rule, right? Or great tip if you're a business owner, how to lower your taxable income by $72,000 a year. And since you're also a professional trader, you can trade the account. In this case, not really trade, I invest. Okay, so I follow my charitable endowment portfolio. Cool. But then what about the situations where it's not your retirement account? What if it's your taxable account? So then I looked into that because I'm like, well, I don't love paying 40% taxes down the road, but that's better than today. But what about a taxable account? Then a tax efficient strategy is important. And then I found a way to lower my taxes even more. But I got to pay taxes on the money today. But then I can put it in an account, and if I do it right, make a boatload of money and pay virtually no taxes. Or at least defer them until I'm dead and then pay no taxes. Okay? Sammy! Yeah, Sammy doing USD yen. Okay, we have that at a negative 1.5. So I'm glad you're crushing it, but it's not the best thing. CAD, Swissy, CAD, Yen are doing way better, like 3 times better. Okay, USD CAD, like this one, the one I've outlined here, it's our biggest short position as far as how successful could you be if you were shorting currencies. Nothing is better than this trade that I outlined in advance. And remember, I did it yesterday morning. So really, 24 hours ago, we set it all up. Boom! And there is no better trade. Okay. Negative 0.43. CAD Swissy is positive 0.47. So this one falling and the other one going up are about the same. So what would you say? A Pearson correlation coefficient of -1 or negative 0.99? There you go. Matthias says, how can I learn more about taxation if I don't live in the United States? You hire a tax attorney. Cool thing is they work by the hour. So you got a huge problem with your taxes or you need some huge advice. And they're like, well, I charge $200 an hour. You're like, good. $500 or less, you just solved a problem worth thousands, 10,000s, hundreds of thousands of dollars to you. And it costs you less than $500 to solve that problem. Dude. Right? Less than a gardener. So anyway, so we're sitting around waiting for bullish and bearish, and you can do it this way. Now, like I said, this is day trading. This is kind of now, kind of stuck in the moment, and you can't get out of it. All right, so what about next week? That's what I really care about because I like scalping, I like day trading, but I love swing trading. I love holding trades too. Many of you have seen me hold trades for a year or almost a year. Yeah. Yeah. Very cool, right? Some of you have seen 1,000% return on investment on a trade. Some of you have seen hundreds of open positions with 98% 4% available equity. Yeah. And you can't do stuff like that if you don't have a plan. So like with that Aussie Swiss franc that we talked about earlier, let's go, should we do Swiss franc again or Aussie? Let's do Aussie, and then, because I think these charts are going to be a little different. Aussie CAD. Okay, I didn't like that one. There's one that didn't work out. Notice, though, that once you're below here, it's dead. This is dead to me. It's dead. And if I'm bullish on Aussie, there's no way in heck I'm selling Aussie CAD. You're like, but the CAD is strong right now. So what? I don't care. I'm not in the moment. I'm in the market. So Aussie Swiss franc we're talking about. Okay, Aussie Swiss franc. If I was a bull and I were to marry. Okay, look, here's the trade from 3 days ago. We're halfway to target, but look at this. You know what I'd do? Okay, this is the week that we're supposed to be here. Therefore, next week's pivot points are adjusting. Okay, so there we go. That's my plan. Cool. I'm at the right price. Is it the right time? Let's drop into a smaller time frame. Or, even better, wait for it to appear here. Oops, let me pull up the platform. We want to know, are we going to buy Aussie Swiss franc? So, okay. Ooh, on a swing trade, dude. It's the best thing we got. Oh my God. So you drop down into day trading and not yet. It's too early. It's only a 0.19. Oh, didn't load. Okay, it's only a 0.19. It's too early. So what do you want to do technically to trade this? What do you like to do? Well, I don't love double bottoms, but you could trade the double bottom if you want. Sure, you could. What I prefer is some sort of higher high, higher low, and I'll catch it here. That's what I like if I were me. And notice that I'm going to hold it all of today and most of next week. Are you okay with that? Now, I can do better if I were me. I would say, well, the month of August is already pre-planned. So you should be trading this bottom here, bottom, bottom, bottom. And based on what I see on the chart, we're actually going to go higher. So let's go even further out. So we hit our target early, we come all the way back, and then the week after that, we are going to, oops, wrong one. The week after that, we're going to go here, but that's not the target either. So now I have to go out to a 4 hour to squeeze this in. Then we're going to hesitate. Then we're going to have a pullback again. And then we're going to end the month right here. So I've just planned this trade out today, next week, the week after that, and then my exit at, can't quite see that, 58.36, is that right? Yeah. Cool. Plus, I'm going to get a carry, I believe. Yep, I'm going to earn 4% annualized, 3.82 annualized, but I get paid every day. Cool. So I collect a bond yield. Oh, so good. Shut the back door. Icing on the cake. Yeah? Dude. Cray. I know, right? Look at that. It's just so good. But can I hold it to the end of the year? Oh, Wayne, dude, there's no way you know that kind of stuff. I don't know. I don't think I even have it. I'd have to add it to our data. And I'm thinking of ways to do it, but let's go there. I don't think I have it though. Aussie, Swiss franc, fundamental, seasonal. No, not even close. But I wonder if I have some correlation data. So let's go to correlation radar and VIX. What do we want? Swissy? Well, we could, okay, VIX goes up. And Swiss franc falls. That's interesting. It's cool to have the numbers. VIX is rising. That's risk off. So Aussie would fall, risk off. Kiwi would fall, risk off. Swissy would fall, but normally that's risk on for me. That's really interesting. See, it's good to have the data, guys, because you can assume things and find out your assumptions are just not true. So when volatility rises, dollar gets strong. That's exactly what I think. CAD gets strong. Well, we're only measuring this over the last 90 days, so highly related to oil. So VIX rises when oil spikes because of geopolitics, and then CAD benefits from that. So just recently, now historically, I doubt it, but currently, yes. Yen and pound are benign. VIX goes up. Aussie and Kiwi fall. Makes sense because those are risk-on assets. And Swissy just doesn't do what I would expect it to do. It's very good. And you're like, Wayne, this is so esoteric. Do people even use this? I'm taking the Series 65, and yeah, this is on. So I get questions on the practice exam about, Jenny is risk adverse and she wants to, and you are going to advise her on how to build a risk adverse portfolio. Here are your choices, and it'll show things like the correlation coefficient, and it'll show you things like beta, and you should know how to do it. And so it's like, well, Wayne, I'm just a retail Forex trader. I'm like, why are you just a retail Forex trader? Now, maybe you only have $5,000 in your account. Maybe you're trading in your mom's basement. Okay. Doesn't matter, does it? Doesn't matter. You should have the data. And so this to me is surprising. Good. I can update my strategies accordingly. So what's VIX doing right now, y'all? What do you think? 1.19? Okay. Up. VIX is up. So right now it's up this amount. VIX is up. And Swiss franc will likely be a little weak. And that's okay with us. Now VIX is up and Aussie does not do well, does it? No. So if VIX turns around, this trade is really going to work. Okay. So now I would still, if I were me, I'd be on this chart here, ready, willing, and buy whenever I felt like I had technical confirmation of my macro quantitative bias. Am I connecting with anybody? Is this starting to make sense? It's cool, right? And think of it. This is you watching 100 charts. It's not true. 56 charts. Well, technically, we're doing it on 3 time frames, so, over 150. But for day trading, you're watching 56 charts in real time. Right there. This is 56 charts. CAD Swissy kicking butt. We need Aussie to wake up from neutral. Why is it neutral? Did you see the VIX? So VIX comes down now that the stock market's open. If there's anything like a potential resolution to the Strait of Hormuz, VIX will fall and this trade will just take off. We're already long CAD Swissy, right? We're already short USD CAD. We're already crushing it. This is the next one that hasn't happened yet. Interesting lines in the sand is this price here. It's kind of why I have it marked. This one shouldn't be a problem because we're bullish, so it's not going to make a lower low. If it did, we'd want to get up. Yeah. Hey, did you know most of this is free? Did you know that? Did you subscribe? Almost everything you saw today is free. And did you subscribe to our channel here on YouTube? That'd be nice. Now that we're in hour 2 of the webinar, it'd be nice if you subscribed or did a little thumbs up thingamabobber. Just saying that you don't have to act like dumb money anymore. The world's changed. You don't have to be in the dark anymore. Okay, let's move on to something juicy. Or do you want to just sit here? Pound Swissy up. Now notice the numbers are not great. So for example, CAD is 3 times stronger than pound, even though pound is second strength. Okay. Swissy is twice as weak as pound is strong. So like pound Swissy will do well. Pound dollar will be, it'll be okay. And again, if you don't like that view, do this view. This will be too limiting. It's easier to read, but maybe you like this. So now it's organizing best bearish, not just bearish, best bearish, second best bearish, third best bearish, fourth best bearish, best bullish, second best bullish, third best bullish. And as you can see, it updates a lot. So I would like to see Aussie Swissy make its way up here, showing that it's a cool trade. It's next on board. It's next on deck. You see it? Yeah, boy. It's almost there. If it pops up here, that's another level of confirmation. That should get your attention. Cool. Cool, man. Cool. So imagine now you're watching dozens and dozens of charts in real time. And I'll remind you, these are not watching each individual chart. To do these calculations, each one of these is doing 15 calculations. It's USD, it's Aussie index versus Swissy index. It's not necessarily what you see on your chart. It's 15 calculations because you got to calculate the value of the Aussie versus everything, the value of the Swissy versus everything, and then do a comparative analysis of the two. And you get the spread of strong versus weak. And that's how you know what to look at before you even go to your charts. You're like, oh yeah, just like we did here. Oh yeah. So you could actually trade like this, you know, where, let me adjust a little bit. I mean, there's so many little hacks, if you will. Where's our Aussie Swiss franc? So this one is not a good trade yet, but is waking up to maybe become one. And so this might be your third trade for the morning or something, and you're waiting for the setup. And you're doing it this way. And you're waiting for the confirmation. Like USD CAD short, that was yesterday's trade. This is another point that I like to make a lot because it's so important. The trade that's working the best right now, we set up 24 hours ago. You should always be setting up tomorrow's trade. So this might take a while for this to turn into a trade. So pulling the trigger on the 5-minute chart here is not even that interesting. You know what the value is? Let's go out to a 4-hour chart. Okay? That we've planned this, or even a daily chart. We've planned this weeks in advance. And there's probably lots of opportunities to accumulate more and accumulate more and accumulate more and all that kind of stuff. But we're looking at Aussie Swiss franc, not for an entry that we're going to, let's say, take in the next hour and exit by the end of the day. If you make some money, it increases your riches, right? You made some money. But money is pointless, especially if there's a high probability you give the money back the next day. You got some money today, you lose some money tomorrow. Degenerate gambling. Wealth is letting your winners run. Like I explained earlier, can you compound this data, this smart data? You have 20 years of data on this Aussie Swiss franc trade. So if the market just happens to give you the trend, we don't know. We don't know. We just know you usually get an Aussie Swiss franc trend. So let's try to trade what's usual, what's normal. If you trade normality, right, then you will probably, if it's normal, let's just say there's a higher probability of it happening. If it's normal and it doesn't happen, that's unusual, and you should know that too. So what I'm saying is, if it's normal for this to go up, then letting this trade run once your stop is at break even requires no extra work from you. The most difficult thing to do is just leave it be. Now, I'm not saying be dumb, because we also have quantitative analysis to know when you probably should take profit. So like Ethereum last month, we had analysis that said it would probably go up 23% in July. Now, that's a big move for any asset. But we said, well, that would be normal. So that trade happened. Then we also knew it would be absolutely, totally normal, meaning probable, that it would give it all back in August, and it has. So we don't know, but we know what's normal. And so for it to rally in July and give it all back in August is good to know. So now we can get to a situation where, hey, we're up 23%, is now a good time to take a profit. And you see a double top at an R1, you're like, okay, I was hoping for M4 or R2, but we're running out of time. It's near the end of the month. I expect it's going to collapse and give it all back. So yeah, I will go ahead and take my 23% and be happy with it. Okay? Because it helps you read the charts if you also know probability. It's like legally and ethically counting the cards. Now, I don't even know, it's not against the law to count cards at a casino. They just don't like you to do it. Am I right on that? Like if you knew there was an 86% chance the next card is not a face card, would it change your betting? No, it depends on your hand. If every card was a random card, oh, well, I don't know. Is there 52 cards in the deck? Well, there should be some cards in your hand. So how many people are at the table? Minus 52. And then, okay, then the dealer throws down some cards. Okay, so now you got to subtract those. And then you got to start paying attention to see how other people are betting. And you're like, okay, strong hand, weak hand, face card, no face card, high card, not high card, ace, no ace. And then finally the dealer flips and it's all face cards. You're like, ooh, okay. So now I know how many cards are out of the deck, but I also know how many face cards are no longer in the deck. And then you look at your hand and you got face cards. So now you got to subtract those face cards. And all of a sudden you're like, ooh, there's a lot of low cards in this deck, and you keep updating and learning because you have probability. So I don't know what Aussie Swiss franc's going to do in August. How the heck would I know? What am I, a genie in a bottle? Okay, no. But something like this usually happens. So do you want to trade usual or unusual? Okay. And our Aussie Swiss franc made it in a winner's list. We're in the winner's circle, everybody. Woo! Hot to go. HOTTOGO. Hot to go. Yeah, we made it. Cool. See, we started with long-term positioning and noticed that in the short term, Aussie Swiss franc was neutral. You're like, neutral? Well, in the long run, this sucker's going up hundreds of pips. So I kind of like neutral. I kind of like not hot. I don't want to buy it after it's rallied. I want to buy it at a better time. So anyway, so we just did 20 years worth of analysis to point out a trade before it happened and confirmed it with technical analysis, right? All right. So now what? Fundamentals. Aussie Swiss franc. We started here. Remember why Aussie Swiss franc? Because we looked at the chart. Love it. Look at this projection. Okay. This is linear projection with standard deviation. Okay, boom, 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 boom. We have this for every currency pair. We have this for every non-currency pair. Gorgeous. Okay, isn't that cool? You want to get your thoughts? Okay. This is right now, guys. Neat technology, right? Yeah. Beep, beep, beep. Okay. First thing you do is look at the entire market. So we're looking at 46 different assets. We break them into Forex, commodities, indices, and whatever the heck this is. All right. Then we organize them by magnitude and use color coding for direction. So if you're trading Forex, the best thing you should be looking at long and short term. Remember, some of this stuff looks out months into the future. Some of it is just what's happening on the charts right now. Things like 4-hour chart, 15-minute chart. Okay? It's all in this math. So, Wayne, I want to trade Forex today. What should I look at? Aussie Swiss franc. You know what usually happens when I do these webinars? Somebody says, Wayne, what do you think about, I can't even click on it. What do you think about euro dollar? I think it's stupid. I think it's dumb. What the heck? What the hell's wrong with you? Well, it's down, but dude, you're ignoring all of this? Really? There's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Sorry, it's getting hard. 13, 14, 15. There's 16 other currency pairs that are better. 16. You don't need 16 trades. Like, what are you doing? Oh, well, my MACD crossed up. Do you even know what the math behind MACD? Like, do you even know what it means? What's your MACD settings? 6, 12, 14? Oh my God. Really? What a horrible way to trade. Okay? So why don't you wake up in the morning and say, well, before I go to my charts, I'm going to check traders. Boop, 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 boop. I'm going to make a list. That's your list, your to-do list for today. Check these out. Long, 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 short, short. Cool. What about commodities? Platinum and silver. Well, I don't really trade platinum, but I love silver. Did you know we've been screaming bloody murder for silver to go up? See, it's green and it's bigger than the other assets. It's better than gold. Did you see silver today up like 8%? You missed it? Yeah, this is meant to be a bitch slap for sure. Wake up, Neo! Okay. It's cool, right? Yeah, I know. I know. See, same thing, just different view. Showing magnitude here. Okay, this is not organized by asset class, but it's like Aussie, Swiss franc, USD yen, Nikkei, okay, Dow Jones. It's helping you just organize it. So maybe you just consider the top 10 and go through your charts. See, start here, then go to your charts. Or start here and look at themes. Aussie, Aussie, Aussie. These are all long positions. Euro, Aussie short. That's a short position, so you're long Aussie. So you could then organize it like technicals, swing trading. Actually, I want to go here. Swing trading, and I only want to look at Aussie, and you're long, right? Your bias is long. So now you can watch these suckers, huh? Okay, or you can go further out. Look at this. It's organized it. Okay, so you only want to buy Aussie. Buy, buy, buy. Good, that makes sense. You only want to buy Aussie. So selling this means buying Aussie. Selling this means buying Aussie. This is supposed to go up. It's not going up. Pass. Your bias. You want this to go up. Pass. Okay. Look at even the linear projection is down. So you're not interested until it reverses and goes up. But notice the top here. You've already hit the most wild extreme target that we have. There is no higher target than yearly R3. We've double top, triple top, lower low, lower high, lower low, lower high. That could be it for the entire year on that trade. So do you want to go long Aussie Kiwi tomorrow if it happened to be bullish on a 15-minute chart? No, it's dead to me now. Wait, what? Wayne, you're watching annual pivot points? Yeah, you're not? What about swing trading? Yeah. Whole different kit and caboodle. So we will watch things like, let's pick one here. Nazi's been, well, let's not do Nazi. I wanted Nikkei. Where's my Nikkei? Oh, duh. Okay, here's my Nikkei. What do we see here? This is a 4-hour chart. We hit the monthly target and it stopped. Do you know how to trade pivot points? Where's my drawing tool? Hang on. Okay, how do you trade pivot points? Okay, that is our best buying price for the month, but only if you're a bull. Well, dude, we've been so hardcore bullish on Nikkei. I mean, dude, the fish are jumping in the canoe on this one, right? So we are definitely a bull. Cool. And the 21 is above the 55. Like by definition, we are a bull. What's the target? Right here. You're like, well, it's not necessarily there. We know if you're a bull, this is the buying price, and this is the target. That's what we know. So when you hit the target, there's profit taking and people get out. Wah, 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 wah. Cool. That's that. That's that. So anyways, I've gone 2.5 hours. I think I've taken too much of your time. Please subscribe to the YouTube channel just so I can keep in contact with you. If you don't want to leave a comment, it'd be nice if you left a comment on the video. I think that helps. I don't know if clicking the thumbs up button helps or not. But I want to remind you, I put the link in the chat. Almost everything you've seen today is free because I'm your best friend. I'm your papa. So it would be a shame if you didn't use it. I do a webinar every morning. You should right, and that's available on the free level. Why don't you come hang out with us every morning? Yeah, there's premium stuff. Maybe one day you'll feel confident. But yeah, then you can level up then. Cool. And even if you want the premium content, did you know that your broker can pay? So yeah. So most of this is free and the super premium stuff is cheap. That's a pretty good deal. So let me be on your team. Been doing this 25 years. I think that's helpful. I have a macroeconomics degree from Harvard. That might be helpful. I have a master's degree from Harvard in financial management. Yeah. Studied at MIT and Oxford and Harvard Business School for alternative investing. I manage endowments. and I'm giving you something that took me 20 years to build for free or cheap. I mean, it's a pretty compelling thing, right? Let me be on your team. Let's work together every day. I've been doing trade non-farm payrolls live this is my 21st year of streaming trade non-farm payrolls live. Cool. Now we're just waiting for the inevitable. Okay. And yeah, that might just work out. Tickety-boo. Peace on earth. May the pips be with you. May your profits be above average. Suthu, tell me, email me, Wayne at Tradars. Okay. And let me know, like, if you feel like you're in a country that is not accessible, let me know. If it's America, we have an execution partner for Americans. If you're international, Traders Way is great. But if you're like, I'm in Timbuktu and I only want to use Timbuktu brokers, I don't know, but let me know how I can help. But the bottom line, guys, is I want us to have and maintain a relationship. I want to work with you. And this isn't a plea for you to like subscribe to something. Like, think of it. If Tradars is amazing and would cost millions of dollars to build, and I'm giving it away for cheaper for free, I have 100 hours of training courses at investorbootcamp.com, and it's $88 a year. Like, you just have to like take a leap of faith, but it's not stepping off a cliff. It's stepping off a curb. Like, move forward. Let's engage. Let's work together. Let's make this work for you. Peace on earth. May the pips be with you. Oh, and if you want the Investor Bootcamp, I don't really promote it, do I? It's still there and it's still great. 100 hours of training courses, not me babbling for hours. You can get the babble stuff on YouTube. No, training courses. Like 16 hours on the energy complex. Yeah, the oil industry. Imagine that. So you know the difference between fracking and cracking. Okay, you know when the President of the United States says that the oil companies are greedy and that it should be illegal for them to gouge people by setting prices high? You hear this a lot by both parties. After this course, you will know how stupid that is, how absolutely stupid that is, because you will know. You'll even learn how to do the contracts if they found oil on your farm and you're going to sign a lease with them. We even cover that. Yeah. So anyways, imagine that we have that for all types of topics, right? So imagine in 16 hours you will be an expert in the oil industry. Okay? You'll know what a logger is in the oil business. Whoa, what? Did you know that? You start drilling a hole, you get maybe 1 mile down, and then you send in a logger. You're like, but Wayne, there's no trees down there. Yeah. I think we even do a full hour and a half on geology. You know? Anyways, I got to run, babe. That was real. Thank you for being part of the community. Please bump up the subscriber level here on TradeRs. It's very modest. Once there's more subscribers, it unlocks my ability to do other things. Maybe I'll start doing courses on the channel. Yeah, I don't know. Help me help you. Have a great one. I'll see you Monday. Oh, and remember, let your winners run. Let your winners run.